This episode of the Lloyd's List podcast is brought to you by Warana. Welcome to the Lloyd's List podcast. I'm Declan Bush and I write about decarbonisation for Lloyd's List. By now, we've noted more than a few times that decarbonising shipping is very, very difficult. The fleet needs renewing now, and a ship ordered today will probably be sailing well past 2050, by which time we're supposed to have reached net zero emissions. But it's not just shipping companies struggling with that investment. Banks and other ship financiers are in a bind of their own, and this is making it harder to help companies clean up their operations. Many shipping markets seem set for a downturn since the COVID boom years, but where does this leave ship finance, and green ship finance in particular? Jan-Henrik Huebner is Global Head of Shipping Advisory at DNV Maritime.
Shipping did very well over the past years, very favorable for the shipping companies. Obviously, many loans have been repaid ahead of time. In parallel, we saw low ordering in some segments, meaning that ship owners as well as banks sit on a pile of cash which needs to be spent, and especially the banks are in need to keep their book and finance new vessels, renew vessels. What we see is a fierce competition among the banks, among the Western banks, but also, of course, with Japanese and especially Chinese banks or Chinese leasing also being involved there, being active at pretty low rates. That is putting pressure on the banks. So we see overall banks operating on fairly low margins currently. But on the other hand, of course, we have a need for more ships. If we continue growing the global trade, if we decarbonize, we will sail slower. We will need more ships for the same ton miles. The ships will be greener and they will be more expensive than previous ones. So there will be an increasing financing need, of course. So it's a balanced picture. Currently low margins, but more need for finance and more need also for green finance.
It's tricky to say exactly how much of ship finance is green finance, but Jan-Henrik estimates it at something like 7 to 10% of the total. There have been some big deals, though. Late last year, Lloyd tied up $4 billion in green finance to buy 24 container ships. The idea of green finance is you offer a slightly cheaper interest rate in return for the borrower agreeing to do greener things. It's good PR for the banks, who tend to have targets for decarbonising their portfolios. Owners get a cheaper interest rate as well as the warm fuzzy PR. But when it comes time to refinance, are these incentives enough to make a difference? Tobias Backer, Executive Director at fund manager Pelagic Capital, says they mostly don't.
For the vast majority of cases, these incentives are fairly small. We're talking basis points and not percentage points.
A basis point is 1/100th of a percentage point for the non-bankers among us. To be sure, on bigger deals every little bit matters, but Backer says greenery and financial considerations in general are just one factor among many influencing borrowers. Commercial and regulatory drivers like the EU ETS and Fuel EU maritime regulations, which require big improvements in fuel efficiency over time, matter a lot more. And Tobias, who's been in the game a long time, has a bigger concern. Clarksons has estimated that shipping will need roughly 60% more capital spending in the next decade compared with the last if it's to meet its energy transition needs.
I simply don't know where that money will come from, to be quite honest. As I said, this was primarily a bank funding market, and the banks are reducing their portfolios. To some degree, the increased capital funding has been coming from Chinese leasing houses, Chinese banks. Given the certain geopolitical climate, I'm not sure that's where the increased funding will come from.
Speaking of that geopolitical climate, if you pause this podcast and listen carefully, what you will probably not hear is the likes of BlackRock and JP Morgan shouting about how much they love the environment, as they tended to a few years ago. President Trump is back in and ESG investing is out, or so we hear. How will this affect shipping's access to capital?
I think for the market itself, U.S. policy will not have a huge direct impact on the ship finance markets. Where we are definitely seeing a change, though, is in the investing space. When we started raising money in this strategy for Pelagic, we would always start off by talking a lot about the energy transition and what we are doing as part of our investment strategy for our green profile. That still matters a lot when you talk to investors in Europe or Japan or California, New York, or Boston. But if you're talking to more conservative areas in the United States, in particular Texas, Florida, southern states in the Midwest, those points are not considered necessarily that important, and in some areas they don't want to hear about it at all. So that is a big change from just a year ago.
Back in January, the 6 biggest banks in the US quit the Net Zero Banking Alliance, the global industry's net zero target-setting group, probably out of fear of right-wing backlash. Shipping, however, may have less cause for concern than some other industries. Jan-Henrik points out that the share of ship finance coming from US-based banks is small. Most of the lenders are in Europe or Asia. And there's a difference between what the banks advertise in their shop window and what they do in practice.
I don't see them stepping back from their commitments, from their actual commitments to decarbonization. Maybe not as public anymore, but of course they see the favorability, the better marketability of more efficient and more future-proof vessels versus conventional ones. So I'm not too afraid that we will see a significant backdrop there. It took quite some time to get the train rolling on the regulatory level, on IMO level, and that was a bit pushed by the banks those days. While now I think the train is rather getting speed on IMO level when the targets are made and now need to be translated into a specific IMO regulation on intensity, for example, and fuel. So that continues, and I think the banks in their credit decision will consider that.
Wirana Shipping Corporation is the oldest and one of the largest cash buyers of end-of-life ships and offshore vessels in the world. During 40 successful years, Wirana has earned the trust of ship owners, ship recyclers, and all the stakeholders in the industry for always honouring our commitments irrespective of market factors, and for being a responsible stakeholder. Wirana has well understood that continuous adaptation and learning the changing requirements of the industry is the key to success.
Regulatory clarity is something we in shipping call for a lot. For lenders, clear standards of what is and isn't green is crucial to avoid allegations of greenwashing. No one wants to give up already thin margins and then find the project they've bankrolled isn't quite as cuddly as it seems. But the problem with standards isn't too few, but too many. Jan-Henrik from DNV laid out some of the bewildering variety to choose from.
I mean, over the last 5 years, we've probably supported 30, 35 something sustainable finance transactions in the maritime industry, and of course followed the developments of standards as well as the market perception on these standards quite closely. I mean, there's different bodies setting standards: LMA, Loan Markets Association, ICMA. On the bond side, I could say there's the CBI shipping criteria. I should rather say there was a CBI shipping criteria because they are pretty outdated meanwhile. There's the EU taxonomy, of course, which came, and we are still in the first phase, but from 26 onwards we will be in the second phase there with requirements tightening. We have taxonomy in Singapore and Thailand. We have the ASEAN taxonomy. We have evolving taxonomy in China. We're currently working with the OECD on developing standards for kind of green ECA lending. That's developing. Am I happy that we have so many different standards? It's not ideal, because I hear from shipping companies that if they talk to a number of banks in course of a larger financing, they are asked pretty different questions, are asked for pretty different requirements from different banks. That's not too helpful. I would hope that we see convergence towards fewer and more clear and reasonable standards there.
Some of that convergence can be seen already, we should note. Jan-Henrik has seen several cases of Korean borrowers with Korean banks applying the EU taxonomy as their green standard, despite nobody involved being located in the EU, the famous Brussels effect in action. Jan-Henrik does have one request for regulators, however.
What we don't have yet is lower capital requirements for the banks, which is a kind of shortcoming, because it's not cheaper for the banks to provide green, I say simplified green as a term for green and maybe sustainability linked and transition finance, compared to conventional finance, meaning that the banks face rather a margin reduction if they provide favorable terms for green loans compared to conventional ones. So that's not the biggest incentive yet. What is needed is that the regulator allows them to reduce capital requirements, if we can see, and I think as we can see, that the risks of investments decrease with more marketable ships, which are greener, more energy efficient, more future-proof.
Jan-Henrik hopes that lower capital requirements would lead to higher bond and loan spreads as lenders pass on the benefit they get, letting them eventually offer a better greenium, quote-unquote. Zooming out, what's this look like in the market today? It boils down to the same technical and regulatory uncertainty that operators are facing. Some owners are investing in dual-fuel new buildings and energy-saving devices. Lenders' job isn't to decide these choices for them, but to help make it happen.
If you asked what shall the banks do, it's not the banks taking the fuel decision. They follow their clients, their borrowers, and of course they ask them, "What's your plan? How do you intend to operate your vessel, at least over the tenor of the loan, if that is a relevant period for the bank, but probably also beyond?" I see that these discussions happening a lot. We get inquiries from a number of ship financing banks coming with specifications of new builds, asking us, "Hey, how future-proof is this vessel? How will this help me, for example, in my Poseidon Principles performance going ahead?" The banks are following the owners, but asking the right questions meanwhile, while they've been possibly a bit more agnostic 5, 7, 10 years ago. They follow that very closely now and want to see a clear plan from the shipping company how to meet the decarbonization trajectory downwards.
Tobias from Pelagic Capital says some of the innovations are turning into investment opportunities, but it's still early days.
Well, you're sort of seeing a two-tier market. I think for any kind of vessel servicing the wind power space, there's definitely dedicated funds. Anything related to battery-driven vessels and true sort of energy transition, there are dedicated funds that have identified this investment space for quite some time. However, that is a very, very small portion of the overall market. The grand scheme of things, these are blue water, deep sea, ocean-going vessels that still have a long way to go in energy transition. And we, as a financial investors and financial capital providers, we have to help that transition instead of just sort of turning off the spigot, which some of the dedicated green funds have done.
So, should you invest in shipping? Tobias points out that at the end of the day, this all represents disruption, and shipping thrives on disruption.
We live in a world where the investing space is quite uncertain. It's hard to identify sectors in the economy where you can see clear opportunities. The stock markets are at an interesting inflection point. Interest rates are uncertain. Real estate across the globe are pretty well priced in. But maritime is interesting enough. There's an uncorrelated asset class, and we generally, or the space generally, does quite well financially when other markets have less direction. So I would say, as overall, the maritime space is a very interesting investment space right now.
That's all we've got time for this week. You can follow more of our coverage on the Lloyd's List website or reach out to me at declan.bush@lloydslistintelligence.com. Thanks to Warana for sponsoring this episode. We'll be back with you next week with more of the stories shaping shipping. Goodbye.